Welcome back to the CFE Brief, where we break down CFE exam topics into clear, practical lessons. Today's focus, the balance sheet, also known as the Statement of Financial Position. Let's explore how it works and how fraud can distort what it shows. What is the balance sheet? The balance sheet provides a snapshot of a company's financial position at a single point in time. It shows what the company owns, assets, what it owes, liabilities, and what belongs to the owners, equity. It's called a statement of financial position for a reason. It captures the company's standing in that moment.
Why CFEs need to understand it? As a certified fraud examiner, you don't just need to read financials, you need to analyze them. Fraudsters often target the balance sheet to hide debt, inflate assets, or misstate equity. So understanding this statement is essential for spotting red flags in financial fraud. Structure of the balance sheet. A standard balance sheet includes assets, current assets like cash and receivables, and non-current ones like equipment and property, liabilities, current liabilities such as accounts payable, and long-term obligations like loans, equity, usually capital contributions, and retained earnings. It's all based on the accounting equation, assets equals liabilities plus equity. This must always balance, otherwise something's been missed or misstated. Key ratios and indicators. Balance sheets are more than just numbers. They help calculate ratios that detect risk. The current ratio shows liquidity. The debt-to-equity ratio reveals financial leverage. Watch for unusual changes or incomplete disclosures. They might be signs of fraud hiding in plain sight. Let's take a real example. A retail company inflated its inventory value by $500,000. On the surface, it looked more valuable, boosting assets and equity. But it was a lie, used to attract investors and cover weak performance. That's a classic balance sheet fraud. Red flags to watch. Keep your eyes open for red flags like sudden increases in non-current assets, strange or unexplained equity movements, liabilities tucked away in footnotes or other categories. Fraud doesn't always scream. Sometimes it whispers from the balance sheet. Quick check-in before we close. Which of these does not appear on the balance sheet? A. Inventory. B. Cash. C. Sales revenue. D. Accounts payable. Answer C. Sales revenue is part of the income statement, not the balance sheet. Thanks for studying with the CFE Brief, your companion for structured CFE exam prep. Up next, the income statement, where we'll explore how fraud affects reported earnings. Don't forget to subscribe, comment, and follow for more, powered by the Ethical Finance Alliance, because ethics and education go hand in hand.